loss and your target. And to do this, we're going to go to our 5-minute chart. All right, so now we're on the 5-minute time frame. The next thing we want to wait for is either the high or the low to be hit. So we want to see price trade into one of these levels before even thinking about a trade entry. And as you can see in this example, we hit the low rather quickly. Now, just because we hit the low and rebounded a little bit doesn't mean we're quite ready for a trade. What we want to wait for is a fair value gap to form back into the first candle's range. Now, if you're not aware of what a fair value gap is, all it is a very simple 3-candle formation where the middle candle is very large, and this results in a gap between the first candle and the third candle's wick. This tells us that the market is moving with a lot of force. Now, at this time, you can enter the trade as soon as this candle closes and confirms that fair value gap, and you would put your stop loss at the candle bodies. Now, for a target, we're going to put a fixed to our target, but I'm going to show you how to get even higher risk to reward later in the video. Because this is the first of many trades we're going to test. We're going to test this over the last few weeks of price action, not to prove it's perfect, but to prove that it's real, and more importantly, to give you guys the confidence you need to trade this profitably. So at this time, you would enter a long because we hit the low and we reversed up to the upside, showing intention to go higher. So you would hit buy, then you would put your stop loss underneath the candle bodies, not the wicks. Okay, you'd put it under the lowest candle body. And then for the target, you would just put a fixed 2R. And as you can see on this trade, we would make about $2,600 and we're risking about $1,300, which is a good risk to reward. Now let's see how this trade plays out. As we can see, the trade moves pretty aggressively, has a little bit of a pullback, but that's okay. And it ends up hitting our target. Now let's move to the next trading day. So as you can see right here, this is the 9:30 a.m. candle. You're going to mark out the high and the low, and then we're going to go down to the 5-minute chart. And all we got to do is wait for one of these levels to get hit. Yes, it is that stupid simple. So as we can see here, the market ends up trading into it. But remember, trading into it's not enough. We need a displacement back into the range. Now, in the last setup, I showed you guys using a fair value gap. And in this setup, I'm going to show you guys something called a smart money push. Now, notice right here, we have this little sequence of up candles. So we have a blue candle, a blue candle. So this is an up move. Consider this all one move. Once we engulf that up move, meaning a candle body closes below it, that as well tells us that we're displacing back into the range. So at this time, just like a fair value gap tells us that the market is being sold off at this high probability area, this also tells us that, and we can enter a trade at the same time. So we would put our stop loss for a short above the highest candle body, and we would take this and we would just target 2-to-1 risk to reward. So as soon as either a engulfing of a series of candles happens, so we have this up move where down move engulfed it, or a fair value gap occurs, you're good to enter the trade. Because all you're doing with these candles is determining whether or not the smart money or the big market participants sold where there was a lot of liquidity. Because once the market moves into these high liquidity zones, the market is forced to show you its hand. So at this time, you would enter a sell, you would take your stop loss and put it right at those candle bodies, and you would take your take profit and just put it at that fixed 2-to-1 risk to reward. Now let's see how this trade played out. As you can see, it went pretty much right to the target. That was May 7th. Let's move to May 8th. As you can see, it's May 8th, 9:30 a.m. Very simple. Just mark out the high and low of the first candle. Then after that, you go to the 5-minute chart and you just wait. It's that stupid simple, guys. Now, what we want to see here is a sharp push back into the range. Okay, so if we see there's not really anything happening yet, the market really isn't showing us that it wants to push back into the range just yet. And then boom, as we can see, the market has formed a fair value gap back into the first candle's range. This is very important that it comes back into the range. So at this time, you would go ahead and execute a long. Same thing every time. It is that stupid simple. Put your target at 2R and your stops at that lowest candle body, and you are good to go. Seriously, guys, that is it. You just wait for that first 30-minute candle to be hit, either the high or the low. Wait for your fair value gap back into the range, and then you set your target